Australia's share market has taken a record tumble amid deepening fears of a global coronavirus pandemic. At the close of trade today, more than $232 billion in value had been wiped away. That's around 10%. It's been the biggest drop in a single week for the Australian market since the peak of the global financial crisis. Now, with increasing fears the US could be the next country to be caught up in the epidemic, it appears the heavy losses could be far from over. Andrew Robertson begins our coverage.
Another day, another stock market bloodbath, the sixth consecutive day of heavy losses.
We're getting a new set of information every 24 hours and we just don't know where this is headed.
Today's information, coronavirus has come to the United States. One person who's had no contact with China has tested positive, while in California more than 8,000 people are being looked at.
When you look at past pandemics and big pandemics, I'm not talking about sort of minor downturns, the effects last for months and possibly even years.
When the dust settled today, the All Ordinaries Index had shed another 3%. All up, since the slide began, it's lost 10%, or a staggering $232 billion. The US market is down 12%. That means markets are now in what's known as a correction, which is losses of 10% or more.
The situation is very fluid, and any information that's coming out is, there's an overreaction.
Despite all the red on the screen here behind me, it's worth remembering the market is still very strong, as this 20-year graph reveals. Just 8 days ago, on Thursday of last week, the market was at a record high. But if coronavirus can't be quickly contained, the global financial crisis gives a clue as to how brutal the market can be. From its high in October 2007, as the GFC gripped the world, half the market's value was wiped away. With Chinese supply chains starting to freeze and company debt levels at record highs, the risk is that what's now a health crisis could morph into the next GFC.
When companies start missing inventory and they can't make the sales they wanted to make, and they're very highly geared, then that's where you can potentially see a debt crisis coming out of this.
The pressure more than ever is now on central banks to step in to try to steady markets, but with interest rates already low, their impact could be limited. Andrew Robertson, ABC News.
Well, the coronavirus may have sparked this week's stock market rout, but there are deeper problems in the global financial system. Business editor Ian Verinder explains.
How low can it go? And how long will this last? The questions everyone's asking, but no one can answer. Uncertainty and fear is a deadly combination in the world of finance. Coronavirus is generating the uncertainty as it extends across Asia, into Europe and the United States. The fear on markets is emanating from a far more familiar source: debt. According to the latest figures, near zero interest rates have seen global debt soar to a staggering $188 trillion US. A big portion of that has found its way to Wall Street, where companies have been borrowing like there's no tomorrow. But instead of investing that ultra-cheap cash wisely, they've been handing it straight back to shareholders. So they still owe the cash, but there's nothing to show for it. It's a formula guaranteed to deliver riches until something totally out of the blue pops up, like a weird virus in China. To contain it, Beijing virtually has shut down the economy. That's starting to bite, and traders suddenly have twigged to the potential damage if Europe and America do the same. Companies could go to the wall, the financial system again would be tested, and unemployment could rise. Financial crisis redux. While this virus remains unchecked, expect more market chaos. In the meantime, central banks are gearing up for yet another rescue mission with rate cuts and money printing. More debt, the only vaccine in the first aid kit.